as what have been mentioned by the good Secretary Salvador Medialdea, the Duterte administration has implemented for the past 6 years game-changing reforms that aim towards economic growth that is felt by ordinary Filipinos. And speaking about game-changing reforms, ladies and gentlemen, to provide now updates from the Economic Development Cluster, please welcome the head of the government's economic team, Secretary Carlos G. Dominguez of Department of Finance.
My fellow colleagues in the Cabinet, led by Executive Secretary Salvador Medialdea, Bangko Sentral Governor Benjamin Diokno, members of the Diplomatic Corps, our reliable bilateral and multilateral partners, business leaders, analysts, investors, economists, fellow workers in government, and friends from the media here and abroad, good morning. Years from now, when the Philippines brings down its poverty incidence to single digits, we will look back to the Duterte presidency as the moment when the country made the turn towards more inclusive growth and prosperity. When President Rodrigo Duterte took office in 2016, he adopted a bold 0 to 10-point socioeconomic agenda proposed by various stakeholders who participated in our first ever Sulong Pilipinas. 5.5 years later, we delivered 90% of this ambitious reform program. Under President Duterte's term, the Philippines made the decisive shift from an inward-looking economy to one ready to compete with the rest of the world. Many reform measures that languished for decades on the shelves of Congress were finally enacted into law. I have to thank everyone who contributed to these successes: our legislators, our friends in the private sector, our reliable development partners, and my colleagues in Cabinet, guided by Executive Secretary Salvador Medialdea. We took a significant step towards lasting peace with the establishment of the Bangsamoro Autonomous Region in Muslim Mindanao. The administration also maintained an unrelenting campaign against criminality and terrorism. The peace and order we now enjoy must be credited to the work of our Security, Peace, and Defense team, led by Secretary Delfin Lorenzana, Secretary Eduardo Año, Secretary Hermogenes Esperon Jr., and Secretary Carlito Galvez Jr. The enactment of the Ease of Doing Business Act paved the way for improved and efficient delivery of public services. I commend the Department of Trade and Industry, led by Secretary Ramon Lopez, here in front of us, for the efficient implementation of this law, which remarkably increased the competitiveness of the country's business climate. We enacted the Philippine Identification System Act, which brings us closer to the goal of achieving e-governance and greater financial inclusion among our people. The National Economic and Development Authority, led by Secretary Carl Chua, has been working tirelessly to accelerate the rollout of this program and immediately reach as many Filipinos as possible. As of March 23 of this year, a total of 61.3 million individuals nationwide have registered for the national ID. Through this program, the Land Bank of the Philippines has cleared the way for 7.7 million formerly unbanked registrants to be part of the formal banking system. In addition, we fulfilled President Duterte's promise of establishing a bank dedicated to the needs of Filipino Filipinos working abroad. The Overseas Filipino Bank is our first branchless, digital-only bank in the country. It now serves overseas Filipinos in 116 countries. To further accelerate financial inclusion and broaden the capital markets, the Bureau of Treasury introduced innovative government securities for small individual investors that can be purchased through digital channels. We also finally implemented the long-dormant Real Estate Investment Trust Act, which has become a powerful financial instrument for the property development sector and small investors. In just 2 years of implementation, the total market capitalization size of the REITs in the country already reached 269.7 billion pesos. Meanwhile, the rice tariffication law was finally achieved after more than 30 years of failed attempts under previous administrations. The law opened up the Philippine rice market and in turn lowered the price of our country's staple food for more than 100 million Filipinos. As a result, rice is no longer the main contributor to our overall inflation rate. The rice tariffication law ensures that farmers benefit directly by providing at least 10 billion pesos each year for mechanization, high-quality seeds, access to credit, and training. Before the law was passed in 2019, the National Food Authority regulated all rice imports, and it was the chief importer of the grain. It received an average of 11 billion pesos a year in tax subsidies. With the rice tariffication, the government has already earned a total of 46.6 billion pesos in rice import tariffs during the first 3 years of implementation. These revenues support the reform and modernization of our agriculture sector. This is a complete reversal of the 11 billion pesos annual average tax subsidies the government provided to NFA every year from 2005 to 2018. The rice tariffication law is just one of the progressive efforts undertaken by the Department of Agriculture led by Secretary Willie Dar, who's here, to build productivity and enhance the resiliency of our agriculture sector. The Duterte administration decisively passed and implemented the most comprehensive tax reform program ever in this country. This provided robust and recurring revenues that helped expand social services and supported our massive economic investments in modern infrastructure. I would like to point out, however, that the success of the tax reform measures cannot be attributed exclusively to the current efforts. This is the logical continuation of decades of reforms arduously passed by previous administrations. TRAIN, or the Tax Reform for Acceleration and Inclusion Act, reduced personal income taxes for 99% of our taxpayers, giving them much-needed relief after 20 years of non-adjustment. Through TRAIN, we have basically given out a 14-month pay every year to our wage earners. Under the law, we imposed excise taxes on sweetened beverages, for which we collect almost 104 million pesos a day. TRAIN likewise mandated the implementation of our first ever nationwide fuel marking program to curb oil smuggling. No past administration increased sin taxes more than once. President Duterte and Congress raised sin taxes 3 times within his term. The excise taxes on tobacco and alcohol products improved funding for the Universal Health Care Program. All in all, TRAIN and other enacted packages of tax reform program enabled the government to raise 504.6 billion pesos in incremental revenues during the first 4 years of implementation. In addition to modernizing our tax policies, the Duterte administration aggressively pushed for the full digitalization of the Bureau of Internal Revenue and the Bureau of Customs. In 2015, only 10% of the country's taxpayers filed their income tax returns online. In 2021, this grew to 99.5%. From the 1.9 million electronic payment transactions made with the Bureau of Internal Revenue in 2015, this number rose to 5.5 million electronic payment transactions last year. These figures are projected to dramatically increase in the coming years as we introduce more digitalization initiatives. Meanwhile, our policy of instilling fiscal discipline among our GOCCs, or government-owned and controlled corporations, allowed us to collect an average of 68.7 billion pesos annually from these firms since we took office. This is more than double the annual average collection of the past administration. Through the bold tax reforms and better tax administration, we were able to raise our revenue efforts to 16.1% of GDP in 2019 from 15.1% in 2015. This was our best performance in more than 2 decades. In 2019, our debt to GDP ratio was at historic low of 39.6% from 42.7% in 2015. The international credit rating agencies recognized us by giving us the best credit ratings ever, ranging from BBB plus to a AAA. As a result, we were able to bring down our borrowing costs and raise bond issuance with very tight spreads in the international market. This high credit rating also spilled over in the low borrowing costs for the private sector. Our Samurai, Panda, Euro, and dollar bonds were all met with strong demand, illustrating the high level of confidence of the international investors in the Philippines. Our robust revenue flow and concessional financing allowed us to sustainably fund the Build, Build, Build program, which is one of the lasting legacies of President Duterte. This administration was able to raise infrastructure spending to above 5% of GDP, double the level recorded by the previous 4 administrations. This would not have been possible without the hard work of our infrastructure implementing agencies led by Secretary Arthur Tugade, former Secretary Mark Villar, Secretary Vince Dizon, and Acting Secretary Roger Mercado. The Philippine railway system is illustrative. After many decades of neglect, the company had only 77 kilometers of rail service by the time the Duterte administration took office. Today, we have 1,209 kilometers of rail service. From only 61 operational stations, this will increase to 208 by the end of this year. In 2016, we had only 224 operational train cars. This has now increased to 1,386. Life is now more comfortable as the Filipinos can now travel more conveniently with an increasingly expansive and efficient railway system. Our fiscal discipline encouraged our development partners to support infrastructure through concessional loans and grants. Since we took office, we sealed 28 highly concessional loan agreements for our flagship infrastructure projects. This includes the country's most ambitious infrastructure undertaking, the Metro Manila Subway Project. With the generous support of Japan, what has once been considered a dream subway is now about to become a reality. Apart from infrastructure, the Duterte administration also invested heavily in social services to boost human capital development. We provided healthcare coverage, housing, unconditional cash transfers, quality jobs, free education in state colleges and universities, and free irrigation water. These programs were all efficiently carried out by the implementing agencies led by Secretaries Leonor Briones, Secretary Rolando Joselito Bautista, Secretary Francisco Duque, Secretary Eduardo del Rosario, Secretary Silvestre Bello III, and Secretary Bernadette Puyat, and National Irrigation Administrator Ricardo Visaya. I also have to thank the Department of the Budget and Management, first led by Ben Jokno and now led by Officer in Charge Tina Kanda, for ensuring the equitable, prudent, transparent, and accountable allocation and use of public funds for these social services and infrastructure projects. To better serve the needs of the Filipino people, the Duterte administration has infused the largest amount of capital into the Land Bank of the Philippines and the Development Bank of the Philippines compared with the combined amounts under all past administrations. When we assumed office, Land Bank had only 88.7 billion pesos in capital, while DBP had 37.9 billion pesos. By the end of April 2022, Land Bank's capital will now be 230.4 billion pesos, making it the second largest universal bank in the country. DBP's capital will now be 76.9 billion pesos. In particular, Land Bank's image as a big rural bank is far in the rearview mirror. The robust capital infusion reinforced Land Bank's financial strength and allowed it to be an effective partner of the government in advancing its development agenda. The capital is being prudently managed and used to finance projects that are needed by the country, not just in the agriculture sector. Land Bank is also the biggest lender to local government units. Other sectors being supported by the bank include healthcare, education, power generation and distribution, water transportation, and housing, all led by the private sector. These game-changing measures and programs made the Philippines one of the economic leaders in the region, growing over 6% annually. The same reforms helped us gain the financial strength to weather the worst of the COVID-19 crisis. Had we not pursued them on time, the impact of the pandemic would have been worse. Our 2020 GDP would have plunged deeper by 13.3% instead of 9.6%. This just only proves that in any battle or emergency, preparation is always the best strategy. When COVID-19 struck, the Duterte administration moved quickly to protect Filipino lives. The Philippines' direct response to the COVID-19 crisis so far amounted to 3 trillion pesos, equivalent to 15.6% of our GDP. Funding our social protection and economic stimulus measures has been a challenge. But the pandemic found us in a strong financial and fiscal position, ready to protect our citizens. The government collected lower revenues due to the lockdown that slowed down economic activity. At the same time, we needed more money to fund the unexpected cost of the pandemic. Fortunately, we had the fiscal headroom to temporarily increase our deficit to GDP ratio from 3.4% in 2019 to 7.6% in 2020 and 8.6% in 2021. We had set out a clear strategy for financing our deficit. We prioritized domestic borrowings, followed by official development assistance, and then, and last, the international capital markets. We determined this plan as the most prudent approach, ensuring sustainability in our debt service. Meanwhile, majority of our budget to procure COVID-19 vaccines for our people was sourced from multilateral banks. We were able to bring together the World Bank, the Asian Development Bank, and the Asian Infrastructure Investment Bank under a joint financing arrangement for the purchase of these life-saving doses. This was the first in the Asia-Pacific region and probably in the world. Our debt-to-GDP ratio increased from a historic low of 39.6% in 2019 to 54.6% in 2020 and 60.5% in 2021. Nevertheless, this ratio remains eminently manageable. The fact that the Philippines was able to maintain all its historic high credit ratings throughout the crisis amidst downgrades among our peers is a testament to our excellent record of prudent spending and fiscal discipline. The disruption brought about by the pandemic is only temporary. Supported by the rebound of revenue collections, our deficit and borrowings will begin to decline for the year. For instance, the national government has started reducing our provisional advance arrangements with the Bangko Sentral ng Pilipinas from 540 billion pesos to 300 billion pesos. This amount will be totally paid off by June 12 of this year. As the pandemic subsides, the Philippine economy is now well on its way to rapid recovery. Our risk management strategy culminated in a full-year growth of 5.6% in 2021, exceeding target and market expectations. This year, we expect our economy to grow by 7 to 9%. COVID-19 cases are subsiding rapidly, while our vaccination program is proceeding apace. Last year, our revenue collection was already 5% higher than in 2020, signaling a return to robust economic activity. This year, we expect to bring back our revenue collections to pre-pandemic levels. Our merchandise trade and remittances are already above pre-pandemic levels. The Duterte administration marked its final full year with an all-time high record of foreign direct investments amounting to $10.5 billion US. We also continued to gain ground in reducing unemployment. Even as the world has been hard hit by the pandemic, our hard-won reforms bolstered our country's ability to recover and rebuild. The enactment of the CREATE, or the Corporate Recovery and Tax Incentives for Enterprises Act, and amendments to the Retail Trade Liberalization Act, Public Service Act, and the Foreign Investment Act will bring in the high-value investments that our country needs to upskill our workforce and further modernize our economy. Our optimism is, of course, tempered by the uncertainties introduced by the Ukraine conflict. We face a situation that will almost certainly raise inflation levels in all countries. This will be due primarily to the spike in oil and commodity prices. Rest assured, the Duterte administration is closely monitoring developments and is doing its utmost to mitigate the impact of oil and food price increases on our people. This is being done through cash grants for the bottom 50% of the population, as well as fuel subsidy and fuel discount programs for the transportation sector and small farmers and fisherfolk. The election season, on the other hand, will not be an issue. We have a long history of orderly and peaceful transfers of powers. The next administration will inherit many hard-won reforms. They will enter the office with the basic groundwork for rapid growth already in place. We will also transition to them a comprehensive fiscal consolidation plan to bring the economy back to its high growth trajectory. Together, we have to create an economy that can provide sufficient taxes so the government can provide the necessary public goods for the continued prosperity of the Filipino people. Our fiscal consolidation plan will help us achieve this. Rest assured, the Duterte administration will redouble its effort to grow the economy faster in its remaining months in office to fully recover our lost opportunities. We will continue to drive up domestic economic activity by proceeding full steam with our massive Build infrastructure program. Infrastructure investments as a percentage of GDP are targeted to reach 5.9% this year. We will continue modernizing our governance system, strengthening our public health capacity, and investing more in our human capital. We will pursue more reforms that will build a truly broad-based and inclusive financial system fit for the 21st century. We will be more active in implementing climate change actions on the ground. In essence, we will continue working hard until the last hour of our mandate to contribute all that we can to our strong economic resurgence. I would like to end my talk with a famous phrase in Japanese naval history attributed to Admiral Heihachiro Togo. The weather today is fine, but the waves are high. The Philippine economy, our ship, has indeed been sailing through fine weather, but the waves of uncertainty remain owing to external developments. No one expected the pandemic. No country was fully prepared for this public health crisis, but we have successfully managed it. However, the experts say other new variants and pandemics could still break out. The Philippine economy is now recovering strongly, but we have to deal with the volatilities produced by the Ukraine conflict. We must also strengthen the resilience of our communities as we face difficulties proposed by climate change. In our highly integrated world, external events could easily break and imperil our prospects. We have sailed through fine and rough weather, but President Duterte has proven to be a strong and steady captain of the ship. The waves may be high, but the ship of state has been masterfully steered. Thank you.